A woman in Massachusetts named Eleanor was 68 years old and a widow of 9 months when her financial advisor called her in for what he described as a routine review. Eleanor and her late husband Charles had been careful, successful people for the entire 43 years of their marriage. Charles had been a senior partner at a Boston law firm for 31 years before he retired. Eleanor had been a high school principal in a wealthy suburb west of the city. They had paid down their colonial home in Wellesley until it was free and clear, and the home was now worth $2,400,000. They had a brokerage account that had grown to $3,100,000. They had retirement accounts totaling $1,800,000. They had a small lake house in New Hampshire valued at $600,000. Total estate, roughly $7,900,000. Federal estate tax exposure starting in 2026, zero, because the federal estate tax exemption had just been permanently set at $15 million per individual under the One Big Beautiful Bill Act passed in 2025. Eleanor's advisor smiled and told her she did not need to worry about estate taxes anymore. He was wrong. Eleanor lived in Massachusetts. Massachusetts has its own state estate tax that begins at $2 million of total estate value. Eleanor's $7,900,000 estate, every dollar of it, was now exposed to the Massachusetts estate tax at rates climbing as high as 16% on the upper portions. The Massachusetts Department of Revenue would be entitled to collect roughly $453,000 from her estate at her death. Charles had died in early 2025, and Eleanor had filed his final federal Form 1040 and a state final return, but neither she nor her financial advisor had filed the federal Form 706, a state tax return, that would have elected portability of Charles's unused federal exemption. Charles had died with effectively zero of his federal exemption used. $15 million of federal exemption lost forever because nobody filed a single form within 9 months of his death. The portability election does not happen automatically. The Internal Revenue Service does not call you and ask if you would like to preserve your spouse's exemption. The estate tax world in this country is a paperwork-driven trap, and Eleanor was already standing inside it. Her advisor had not told her she might still owe $453,000 to her own state. Her advisor had not told her she had let $15 million of federal protection evaporate. The mistakes Eleanor was making, and the mistakes the advisor had failed to catch, are the same mistakes hundreds of thousands of widows and successful families across the country are making right now in the first months after the new federal law took effect. Here is what happened, and here is exactly how you make sure it never happens to your family. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Paul Merrick, and this is Don't Die Broke. I spent more than 20 years as a certified financial planner watching good people make avoidable mistakes that cost them everything they worked for. Every week on this channel, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me explain what changed and why it matters, because once you understand the architecture, you will see exactly why so many estates are caught flat-footed. The federal estate tax exemption has been a moving target for decades. In 2017, the Tax Cuts and Jobs Act doubled the exemption from roughly $5.5 million per person to roughly $11 million per person, indexed for inflation. By 2025, the exemption had grown to $13,990,000 per person, but it was scheduled to sunset back to roughly $7 million on December 31st of 2025. Then, Congress passed the One Big Beautiful Bill Act in mid-2025. Section 11011 of that act made a permanent change. Effective January 1st of 2026, the federal estate tax exemption is $15 million per individual and $30 million per married couple, indexed for inflation in future years. There is no sunset. The exemption does not phase out. For the first time in over 20 years of estate planning, families can plan around an exemption that is not scheduled to disappear. That is the good news. Now here is the part that almost nobody is hearing. The federal exemption is only one piece of the estate tax picture. 12 states and the District of Columbia still impose their own estate taxes. 6 states impose inheritance taxes, which are paid by the heir rather than the estate. The state exemptions are nowhere near the federal $15 million. Oregon's exemption is $1 million. Massachusetts and Washington each have a $2 million exemption. Maine, Maryland, Minnesota, Vermont, Rhode Island, Hawaii, Illinois, New York, Connecticut, and the District of Columbia all impose state estate tax, with exemptions ranging from $1 million to roughly $7 million, depending on the state. Inheritance tax states include Pennsylvania, Kentucky, Iowa, Maryland, New Jersey, and Nebraska. Pennsylvania's inheritance tax can reach 15% on transfers to siblings and stepchildren. Nebraska's tax can reach 18% on transfers to non-relatives. The federal exemption protects you from the Internal Revenue Service. Your state of residence at the time of death determines whether your state will reach into the estate after the federal share is settled. And in many of these states, the rules are actively hostile to families who think they have already done their planning. Let me put numbers on this so you understand the stakes. Scenario 1, Eleanor in Massachusetts. Total estate of $7,900,000. Federal estate tax exposure, 0, because she is well below the $15 million federal exemption. Massachusetts estate tax exposure. The entire estate above $1 million is subject to Massachusetts tax at graduated rates from roughly 0.8% to 16%. The Massachusetts estate tax kicks in at $2 million of total estate value, but once you cross that threshold, the entire estate from $1 is taxable, not just the portion above $2 million. This is the Massachusetts cliff effect, and it catches families completely off guard. Eleanor's estimated Massachusetts estate tax bill, approximately $453,000. Compare this to a person in identical financial circumstances who lives in New Hampshire, just 60 miles north. New Hampshire has no state estate tax, no state inheritance tax, and no state income tax. Same estate, same heirs, $453,000 in tax difference, based entirely on which side of the state line the decedent claimed as primary residence on the date of death. Same family, same money, same children. One state line, $453,000. Scenario 2. A retired couple in Pennsylvania, Robert and Margaret, both age 76, combined estate of $3,200,000. 2 adult children, both still living in Pennsylvania. Robert dies first. His individual share of the estate passes to Margaret under the unlimited marital deduction at the federal level. No federal estate tax and no Pennsylvania inheritance tax because Pennsylvania exempts transfers to a surviving spouse. So far, so good. Margaret dies 11 years later. Her estate, by then grown to $4,100,000 through investment growth, passes to the 2 children. Federal estate tax? 0, because she is well below the $15 million individual exemption. Pennsylvania inheritance tax, 4.5% on the entire estate passing to lineal descendants. The Pennsylvania inheritance tax bill on a $4,100,000 estate is approximately $184,500. The tax is paid by the heirs, not by the estate. Each of the 2 adult children writes a check to the Pennsylvania Department of Revenue for roughly $92,000 within 9 months of Margaret's death, or they pay penalties and interest. There is no federal exposure. There is no real estate tax problem. There is a state-by-state architecture that almost nobody plans for until the funeral. Scenario 3. A snowbird couple, James and Carol, both age 74. They lived their entire working careers in New York State. They retired in 2017 and bought a condominium in Naples, Florida. They spend October through April in Florida and May through September in their original home in upstate New York. They believe they are Florida residents. Their adult son lives in New York. Their accountant files a Florida state tax return for them. James dies in March of 2026 while at the Florida condominium. His total estate is $6,800,000. His federal estate tax? 0. Now here is where it gets critical. New York State imposes a state estate tax with an exemption of approximately $7.16 million in 2026, indexed for inflation. New York also has a clipper effect or cliff rule of its own. Once you exceed the exemption by more than 5%, the entire estate becomes taxable from $1 rather than just the excess. Florida has no state estate tax at all. The question of where James was domiciled at the time of his death is a fight worth potentially $700,000 in New York estate tax. New York is famously aggressive about claiming residency for snowbird decedents. They look at the location of the primary physician, the dentist, the country club, the church, the children, the family pet, the burial plot. They look at the address on the federal income tax return, the state of voter registration, the state of driver's license, where the decedent kept their checkbook, where they received their mail, and what state the obituary mentions. James and Carol had not changed their voter registration. They had not changed their driver's licenses. They had kept their longtime New York physician, who saw them every August. Carol's mother was buried in upstate New York, and James had purchased the adjoining plot decades earlier. James was vulnerable to a New York residency challenge that would expose his entire $7 million estate to the state estate tax. The fight could cost his estate $700,000. Same condominium, same Florida driver's license, if he had bothered to get one, same legal architecture. The difference is paperwork over years, not weeks before death. Now here is where it gets critical. There is a federal portability election that catches more widows and widowers than I can possibly tell you about, and you need to understand it because it is now more important than it has ever been. When your spouse dies, any portion of their $15 million federal estate tax exemption that they did not use during their lifetime can be transferred to you, the surviving spouse, increasing your own exemption by the unused amount. So if your spouse dies with their full $15 million exemption unused, you become the holder of a $30 million federal exemption when you eventually die. But this transfer does not happen automatically. The surviving spouse, or the executor of the deceased spouse's estate, must file a federal Form 706, the United States estate tax return, even if no federal estate tax is owed. The form must be filed within 9 months of the date of death, or 15 months with an automatic 6-month extension. Miss that deadline, and the deceased spouse's federal exemption is gone forever. There is a special simplified procedure under Internal Revenue Service Revenue Procedure 2022-32 that allows a late portability election up to 5 years after death for estates that were not otherwise required to file Form 706. But that procedure has its own conditions and is not automatic. Eleanor, in our opening scenario, was already inside the original 9-month window when her advisor told her she did not need to worry about estate taxes. The clock was running and nobody was watching it. By the time she finds another planner who knows this rule, her ability to elect portability may be limited or gone. Charles had what was effectively a $14 million unused federal exemption that should have transferred to Eleanor, doubling her individual exemption to roughly $29 million for her own death down the road. Without the portability election, Eleanor's federal exemption is just $15 million. Now in her case, the federal exemption does not matter because her estate will be well below $15 million. But for families a generation younger or with future growth assets, $14 million of unused federal exemption walked away from on a paperwork technicality is the kind of mistake that destroys generational wealth. Here is the part that changes everything. There is a hidden estate planning superpower in the federal tax code that protects almost every American family every time a spouse or parent dies, and most people never even hear about it during the funeral. It is the step-up in basis rule under Internal Revenue Code Section 1014. When a person dies, the assets they owned outside of retirement accounts, the brokerage account, the home, the rental property, the family business interest, receive a new tax basis equal to the fair market value on the date of death. The decades of capital gains that accumulated during the decedent's lifetime are wiped out for federal income tax purposes. The heir inherits the asset at the new stepped-up value. If the heir sells the asset shortly after inheritance, they pay essentially zero federal capital gains tax because their cost basis is the date of death value. For a couple who bought a Wellesley Colonial in 1978 for $110,000, lived in it for 47 years, and have watched it appreciate to $2,400,000, the unrealized capital gain is over $2,200,000. Sell it during the surviving spouse's lifetime, and that gain is taxable, with primary residence exclusions of $250,000 for a single filer or $500,000 for joint filers, leaving roughly $1,700,000 of taxable gain at long-term capital gains rates. Hold it through death, and the heir inherits with a fresh basis of $2,400,000. They sell the day after probate, they recognize zero gain. That is the full step-up. It is one of the most powerful estate planning tools in American tax law, and it requires absolutely no planning to capture. You just have to not sell appreciated assets near the end of life when you do not need the money. Many widows and widowers, panicking about the new role of managing investments alone, sell appreciated stock or rental property in the months after the spouse dies, recognizing decades of capital gain that would have been completely wiped out had they simply held a few more years. Same asset, same family. One decision destroys hundreds of thousands of dollars of basis. Scenario 4, briefly. A widow in Minnesota named Patricia, age 71. Her husband Daniel died 8 months ago. Their primary asset was a brokerage account with $3 million of stock with a cost basis of $400,000. Patricia, panicking, told her broker to sell the entire portfolio shortly after Daniel's death. She recognized $2,600,000 of long-term capital gain on the joint account. Federal long-term capital gains tax at 20%, $520,000. Net investment income tax of 3.8% on the gain, $165,000. Minnesota state capital gains tax at 9.85%, $256,000. Total tax, roughly $941,000. If Patricia had instead held the assets through the date of Daniel's death, the half of the joint account that belonged to him would have stepped up to date of death value. In a community property state, both halves would step up. Minnesota is not a community property state, so only Daniel's half stepped up, which would have eliminated approximately $1,300,000 of recognized gain. Holding through the date of death rather than selling shortly before would have saved Patricia roughly $470,000 in combined federal and state taxes. The asset was the same. The decision to sell at the wrong moment cost her family nearly $500,000. Here is your action checklist, and I want you to take this seriously because nobody is going to hand you these instructions automatically. Number 1, find out which state you currently reside in for estate tax purposes. The list of states with their own estate or inheritance tax for 2026 includes Massachusetts, Washington, Oregon, Maine, Minnesota, Vermont, Rhode Island, Hawaii, Illinois, New York, Connecticut, the District of Columbia, Pennsylvania, Kentucky, Iowa, Maryland, New Jersey, and Nebraska. If you live in any of these states, your estate plan needs to account for the state-level exemption and rates, not just the federal $15 million. Number 2, calculate your total estate value. Add together the fair market value of your home, your retirement accounts, your taxable brokerage accounts, your life insurance death benefits if you own the policies, any business interests, real estate, valuable personal property, and minus any liabilities. The total is your estate. Compare that number to your state exemption first and the federal exemption second. Number 3, if you are a surviving spouse, file Federal Form 706 within 9 months of your spouse's death to elect portability of their federal estate tax exemption, even if no federal tax is owed. The deadline is automatic. The form is filed with the Internal Revenue Service. There is an automatic 6-month extension available with Form 4768. If you missed the original deadline because nobody told you about it, ask a qualified estate attorney about Revenue Procedure 2022-32 for late election relief up to 5 years post-death. Number 4, if you are a snowbird and want your state of domicile to be the no-tax state where you spend the winter, change your voter registration, your driver's license, your vehicle registration, your bank's address of record, your physician, your dentist, your church, the address on your federal income tax return, and your obituary intentions. The state you are trying to leave will fight you on this if there is money at stake. Build a clean paper trail starting today, not after the decedent has died. Number 5, do not sell substantially appreciated assets in the months immediately before or after a spouse's death without first consulting an estate tax professional about the step-up in basis. Wait, hold, inherit at the stepped-up value, sell after the step-up has occurred. Number 6, the new federal exemption permanence under the One Big Beautiful Bill Act eliminates the urgency to make large lifetime gifts that families had felt with the prior law's looming sunset. Many families rushed gifting strategies in 2024 and 2025, expecting the exemption to drop. With permanence at $15 million, you have more breathing room. Reassess any urgency planning that was structured around the now-defunct sunset. Number 7, the 3-year look-back rule for gifts is real but limited. Internal Revenue Code Section 2035 brings certain transfers made within 3 years of death back into the gross estate, particularly transfers of life insurance policies. Plan around this if you are doing irrevocable life insurance trust planning. Number 8, if you live in or own property in a state with estate or inheritance tax, consider whether moving real property into different ownership structures or relocating residency to a no-tax state makes sense for your family. The savings can be 6 and 7 figures. Number 9, the federal estate tax return, Form 706, and the state estate tax return are not necessarily the same return. Many states require their own form, often filed with the State Department of Revenue. Coordinate both filings with a qualified estate attorney and certified public accountant. Do not assume the federal filing covers the state. Same widow, same estate, same children. Eleanor in Massachusetts is on track to lose $453,000 to the state estate tax that her federal-focused advisor never mentioned. Robert and Margaret in Pennsylvania will see $184,500 come out of their children's inheritance under a state inheritance tax that does not even exist at the federal level. James in Florida, or New York, is in a residency fight that could swing $700,000 in either direction. Patricia in Minnesota recognized $941,000 of avoidable capital gains tax in a panic sale 8 months after her husband died. The difference between these outcomes is not luck, it is not a loophole, it is the actual layered architecture of federal estate tax under the One Big Beautiful Bill Act, state-by-state estate and inheritance tax law, federal portability under Internal Revenue Code Section 2010 subsection C, the 3-year look-back under Section 2035, and the step-up in basis under Internal Revenue Code Section 1014. The rules are real, the deadlines are real, and almost no general financial advisor walks a widow through any of them in the first 9 months after a death, when most of the irreversible decisions get made. This is how successful families die broke, not from a stock market crash, from paperwork that was never filed in time. This is Paul Merrick, and this has been Don't Die Broke. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a recent widow or widower, or a family with substantial assets in a state with its own estate or inheritance tax, send them this video today. 9 months is a short window and the clock is already running. And drop me a comment and tell me this. Did anyone, your attorney, your financial advisor, or your accountant, explain federal portability and the state estate tax to you in the year after your spouse died, or before either of you began estate planning? Yes or no? I read every single one, and the most common questions become future videos. I will see you in the next.